Almost every investor has heard that options trading is dangerous, complicated, and reserved for Wall Street professionals who wear suits and shout at blinking screens. And for most option strategies, that's absolutely true. Naked puts, call spreads, straddles, those can wipe out your account in a single bad trade. But there is one options strategy that is so conservative, so low risk, that even Warren Buffett has used it for decades. It's called a covered call, and if you own at least 100 shares of any stock, you can start generating monthly income from that position tomorrow, without selling a single share, without increasing your risk, and without any of the voodoo that makes most option strategies so dangerous. If you stay until the end of this video, you'll learn exactly how covered calls work, step by step, with real examples from 2026. I'll show you how to calculate your premium income, how to choose the right strike price and expiration date, and the one critical mistake that turns a covered call from a conservative income strategy into a regret. You'll also learn the tax implications, the best brokerage platforms to use, and why covered call ETFs like JP have exploded to over $45 billion in assets. By the time we're done, you'll be ready to make your portfolio work harder for you every single month. My name is Your Name, and today we're going to turn your stocks into a monthly paycheck. Let me start with a story that will show you the power of this strategy. A viewer named Mike owned 500 shares of ExxonMobil. He bought them years ago at $80 per share. In 2026, Exxon was trading around $148 per share. He loved the stock, but it wasn't going anywhere fast. It was just sitting there, paying a decent 2.8% dividend. Mike wanted more income. He learned about covered calls. He sold 5 covered call contracts on his 500 shares, 1 contract for every 100 shares. He sold the June 2026 call option with a strike price of $150. The premium was $6.40 per share, or $640 per contract. That's $3,200 in cash up front in his pocket. He kept his shares, he kept his dividends, and he collected $200 for agreeing to sell his shares at $150 if the stock rallied that high. That's a 4.5% return in just 58 days, or about 28% annualized, on top of his 2.8% dividend. Even if Exxon goes nowhere, Mike just earned an extra $3,200. That's the power of covered calls. Now, I can hear what some of you are thinking, but what if Exxon rallies to $200? Won't Mike lose out on all those gains? Yes, that's the trade-off. And I'm going to be completely honest about that risk. But for Mike, who was happy to sell at $150 anyway, the premium was just a bonus. A covered call is not for every stock or every investor, but for the right situation, it's one of the most reliable income-generating tools in all of investing. So what exactly is a covered call? A covered call is an option strategy where you own at least 100 shares of a stock, and you sell or write a call option against those shares. The person who buys the call option pays you a premium for the right to buy your shares at a specific price, called the strike price, on or before a specific date. In exchange for that premium, you agree to sell your shares at the strike price if the option buyer exercises their right. The word covered means that you already own the shares. If you sold a call without owning the shares, that's called a naked call. And that's where the unlimited risk comes in. Don't ever do that. But with a covered call, your maximum obligation is to sell shares you already own. Think of it like this. You own a rental property. You could just let it sit there and collect rent. That's your dividend. Or you could also rent out the parking space to a neighbor for extra cash. That's the covered call. You still own the property, you still collect rent, but now you have an extra stream of income. The only catch is that if the neighbor wants to buy the parking space at a price you both agreed on, you have to sell it. That's the trade-off. You give up some upside in exchange for immediate cash. Now, let me walk you through exactly how to sell a covered call, step by step. Step 1. Own at least 100 shares of a stock you're willing to sell at a higher price. Asterisk. Options contracts are standardized in lots of 100 shares. If you own 100 shares, you can sell one contract. If you own 500 shares, you can sell 5 contracts. The stock should be one you are comfortable owning for the long term, but you're willing to part with it at a specific price. For example, if you bought Apple at $150 and you'd be happy to sell at $200, Apple is a good candidate for a covered call. The shares are your collateral. Without them, the trade is naked, dangerous. Step 2. Choose your strike price. The strike price is the price at which you agree to sell your shares. A higher strike price gives you more upside potential if the stock rallies, but the premium you receive will be lower. A lower strike price generates a higher premium, but it also increases the likelihood that your shares will be called away, meaning you'll have to sell them. Most covered call writers choose a strike price that is out of the money above the current stock price, so they have room for some appreciation while still collecting a decent premium. Asterisk. Step 3. Choose your expiration date. Options expire on specific dates. Longer dated options, say 6 months out, command higher premiums because there's more time for the stock to move. Shorter dated options, monthly expirations, give you less premium but allow you to sell new calls more frequently and adjust your strategy. There's a trade-off between premium size and flexibility. Many income-focused investors prefer monthly expirations because they can generate consistent monthly cash flow. Step 4. Sell the call and collect your premium. Asterisk. Once you've selected your strike and expiration, you place an order to sell to open a call option. Your brokerage may require options approval, typically level 1 or level 2, which allows covered calls. The premium is credited to your account immediately. You can keep it, reinvest it, or use it for anything you want. Step 5. Wait and see what happens. At expiration, one of 3 things will happen. First, if the stock price is below your strike price, the option expires worthless. You keep your shares, you keep your premium, and you can sell another call next month. This is the ideal outcome for income generation. Second, if the stock price is above your strike price, the option will be in the money, and it will likely be exercised. Your shares will be sold at the strike price. You keep the premium and the proceeds from the sale. You no longer own the shares, but you locked in a profit plus the premium. Third, you can close your position early. If the option is about to expire in the money and you want to keep your shares, you can buy to close the call, typically at a loss, but you keep the shares. Or you can roll the call to a later expiration date or a higher strike price. Rolling is an advanced technique, but it's common among active covered call writers. Now let me give you a real example from 2026 using Pfizer. Pfizer's stock was trading around $27.23 per share. An investor bought 100 shares for about $2,723. They sold the May 15, 2026 call option with a $30 strike price for $24 per share, generating $24 in premium. That's a 0.9% return in 65 days, or about 10.9% annualized. If Pfizer rises above $30, the shares will be called away, giving the investor a total return of about 10.9%, or 61% annualized. That's a huge yield for a conservative blue-chip pharmaceutical stock. Here's another example with ExxonMobil. In April 2026, Exxon was trading around $148.36. An investor bought 100 shares for $14.836 and sold the June 18, 2026 $150 call for $6.40 per share, generating in $40 in premium. That's a 4.5% return in 58 days, or about 28.4% annualized, on top of the 2.8% dividend yield. Even in a flat market, that investor just earned an extra $640. Now, let me show you a longer-term example with Cisco Systems. Cisco was trading around $82.35 per share. An investor sold the December 18, 2026 call with an $85 strike for 7x per share, generating $760 in premium on an $8,235 investment. That's a 10.2% yield in 319 days, or about 7% annualized, well above Cisco's 2.1% dividend yield. And there's still room for about $265 of capital appreciation before the shares get called away. But here's the reality check that most YouTubers won't tell you. Covered calls are not a magic money printer. They have real trade-offs. Let me walk you through the pros and cons honestly. Asterisk. The pros first: you generate immediate income. The premium is cash in your pocket today. Second, you get some downside protection. The premium you collect partially offsets any decline in the stock price. If your stock drops, you still have the premium to cushion the blow. Third, you can lower your cost basis. Every premium you collect reduces your effective purchase price for the shares. Fourth, in flat or gently rising markets, covered calls can significantly outperform buy and hold because you're harvesting premium while the stock stays range-bound. The CBOE found in 2024 that covered calls can add 1 to 3% in monthly income and cut volatility by 10–15%. The cons first, and most importantly, your upside is capped. If the stock rallies far above your strike price, you will be forced to sell at that lower price, missing out on potentially massive gains. In a steeply advancing market, covered call strategies lag badly. The second con is that you still bear the full downside risk of the stock. The premium only offsets a small portion of a large decline. Third, covered calls can trigger early assignment. With American-style options, the buyer can exercise at any time before expiration. If the stock goes deep in the money, your shares could be called away early, forcing you to sell before you intended. Fourth, selling covered calls reduces your ability to sell the stock. While your call is open, you cannot sell the underlying shares unless you close the call position first. Let me tell you a cautionary tale. A viewer named Tom owned 1,000 shares of NVIDIA at $120. He sold covered calls with a strike price of $150, collecting $5 per share in premium, $5,000. He was thrilled. Then NVIDIA announced blowout earnings and the stock skyrocketed to $300. Tom's shares were called away at $150. He made a profit of $30 per share, plus the $5 premium, $35 per share total, or $35,000. That sounds great, but if he had just held, he would have made $180 per share, $180,000. He left $145,000 on the table. He told me, "I won the battle but lost the war." That's the risk of covered calls. They work best on stocks you're already willing to sell at a certain price, not on high-flying growth stocks you want to hold forever. So who should use covered calls and when? Covered calls are best suited for investors with a neutral to slightly bullish outlook. On a stock you think it will go up modestly or stay flat but not explode. They work well on low volatility, defensive stocks like utilities, consumer staples, and blue-chip dividend payers. Exxon, Pfizer, Cisco, Procter & Gamble, Coca-Cola, these are ideal candidates. They also work on broad market ETFs like SPY or QQQ. In fact, covered call ETFs like JPI have exploded in popularity, now holding approximately $45 billion in assets. These funds sell covered calls on their underlying holdings and pass the income to shareholders. They offer a simple, passive way to access the strategy without managing it yourself. Asterisk, what about taxes? One of the most overlooked aspects of covered calls is the tax treatment. Option premiums are generally taxed as short-term capital gain, regardless of how long you hold the position. That means you pay your ordinary income tax rate on the premium, up to 37% for high earners. If you hold the underlying shares for more than 1 year, any capital gain from the sale of the shares is taxed at the lower long-term rate. But the premium itself is not eligible for that favorable treatment. Talk to your tax advisor, but be aware that covered call income can be tax inefficient in a taxable brokerage account. That's why many investors prefer to use this strategy inside a Roth IRA or traditional IRA, where the tax treatment is not an issue. What about brokerage fees? Commission costs have come down dramatically. Most major brokers now charge between $0 and $1 per options contract. Interactive Brokers charges as low as $1.35 per contract for high-volume traders, while Robinhood offers commission-free options trading. For a typical investor selling 1 or 2 contracts per month, the fees are negligible. However, if you're selling calls on many positions, the fees can add up. Always check your broker's fee schedule. Step-by-step guide to selling your first covered call. Asterisk. Let me walk you through the mechanics in plain English. Step 1. Ensure you have options trading approval on your brokerage account. Most brokers offer Level 1 or Level 2 approval for covered calls. You may need to answer a few basic questions about your experience and risk tolerance. Do this now. Step 2. In your account, navigate to the option chain for the stock you own. You'll see a list of strike prices and expiration dates. Look for a strike price above the current stock price, out of the money. The further out of the money, the lower the premium, but the higher the chance you keep your shares. Step 3. Select an expiration date. Monthly expirations are popular because they allow you to repeat the strategy every month. Longer expirations lock in a larger premium but reduce your flexibility. Step 4. Asterisk. Place a sell to open order for the call option. You'll be selling 1 contract for every 100 shares you own. Enter the price. You can use the current bid price or set a limit order. If the trade executes, the premium is credited to your account immediately. Step 5. Monitor the position, but don't obsess. The worst thing you can do is panic if the stock rises above your strike price. Remember, you agreed to sell at that price. If you can't accept that, you shouldn't have sold the call. Step 6. Asterisk. At expiration, if the option is out of the money, it will expire worthless. You keep your shares in the premium. If the option is in the money, your shares will be called away. If you want to keep your shares, you can buy back the call before expiration, but you will likely pay a higher price to close it than you received when you sold it. Asterisk. The biggest mistake that ruins covered calls. The most common mistake is selling calls on stocks you are not willing to sell. If you love your shares and you'd be devastated to lose them at a certain price, do not sell a call at or below that price. Know your exit price before you enter the trade. The second biggest mistake is selling calls during periods of high expected volatility, like before earnings announcements. If a stock is about to report earnings, the option premiums will be elevated, but so will the risk of a massive move that triggers assignment. Many experienced covered call writers avoid selling calls into earnings. Asterisk. The rolling strategy, how to manage a losing call. If the stock